Good morning, everyone, and thank you very much for joining me. This is the morning market review. It's Friday and it's the 15th of September. My name is Russell Shaw. I'm a senior market specialist at FXCM. I just want to draw your attention to my email address, rshaw@fxcm.com. If you'd like to correspond, that's the email address to use. Just going to bring up our disclaimers. Start off with a high risk investment warning. I'll keep this on screen for a few moments. Also want to just let you know I have a meeting in at the top of the hour, so the next sort of 18 minutes. So we'll probably end sort of pretty close to the top of the hour. So just giving you the heads up there. Just keep the high risk investment warning on the screen for a few moments. Good morning, Kim, Raj, James, and Howard. Good morning to you all and welcome as always. Thank you to everyone who's logged in. Very much appreciated. All right, let's just bring up the market commentaries disclaimer. And our references MarketScope 2.0 and TradingView.com. I just want to start off with TradingView.com. I want to go through to the real rate and let's take a look and see if there's anything worth noting. Okay, so excuse me. We are at right about 2%. We're just shy of 2%, 1.95%. 2% seems to be the resistance area. We're going to have the Fed speaking next week, the rate decision. I'm of the opinion that there won't be a hike, but I think that I beg your pardon, Fed Chair Powell will be hawkish in tone. I think he'll say that the fight against inflation is not done. You know, I think the mantra of higher for longer continues, and I think that is net dollar supportive. And if that's net dollar supportive, then there probably be pressure on the other pairs, the other gold, the risk assets, and the majors in particular. Let's just go through to the daily here. All right, so we had the real rate move up yesterday. The reason I wanted to show that is because we did have some dollar movement yesterday as well. Let's just bring up how we looked at the dollar in yesterday's morning market review. We started with the weekly and we saw the weekly trend, which of course higher trough, higher peak. We said that it's above the 30-week moving average. We said that the 30-week moving average is pointing up. We said that the RSI is above 50. We then went down to the daily chart, and what we saw is that it is in zone 1. That's between the upper red and the upper blue. That's our bullish area, and the RSI on the daily RSI, I think, is looking pretty good. It's just moving smoothly between 50 and 80. And then we wanted to see, well, okay, we've got the weekly that's seemingly pointing to upwards pressure. We've got the daily, which seems synchronized with that. Is there any way that we can potentially use the hourly to have some sort of timing there? So we went down to the hourly, and it actually worked out pretty well yesterday. We said here's the EMAs looking to cross over. We said maybe we'll get this movement up. So there was the swing yesterday. So for the, so nice cooperation from the market yesterday, and the stochastic moved up and went into the upper quintile for a few hours. Not the biggest sort of momentum push we've seen. What was the big catalyst there? What was the big catalyst? So I think first of all, on Wednesday, so going back 2 days, we had the CPI numbers come out. They were slightly higher than anticipated. Then yesterday, so yesterday was very interesting in terms of the ECB, right? They did hike by 25 basis points, and that puts their deposit facility at 4%. I think the highest it's ever been. Now, since the the beginning of the ECB, but the way it was communicated was quite dovish, almost as if this is the last in the hiking cycle. Now we're going to leave rates elevated, and I think the idea here was there's a fear that if you push rates too hard in the Eurozone, you're actually going to crash the economy. The economy is really much weaker than it is on the US side of the Atlantic. And I think that came across quite strongly. So we had a big impulse up in the dollar, and it really moved quite nicely. Okay, so sort of behaved as anticipated. Nothing is guaranteed in trading, so you want to use a stop loss, you want to use risk management. And if we take a look at the euro US dollar, just as the other side, let's just bring that up. And we're going to come back to the US dollar in a moment, but you can really see, let's go from the top down. You can really see we've got a downtrend in euro. We've got a low peak followed by a lower trough. We've got it below the 30-week exponential moving average, and we've got that exponential moving average pointing down. And then the idea here is the RSI is below 50 as well. So there is pressure to the downside. Let's go to the daily, right? Let's see if the daily syncs up with the weekly. So we use our zones here, all right? We're in zone 3. That's the bearish area, the bearish channel. That's between the lower blue and the lower red. You can see that the RSI here also just moving along quite smoothly between 20 and 50. So we go down now to the hourly. Now it's easier, obviously, in hindsight because central bank announcements are extremely volatile, and if they go against you, they go against you viciously right through the stop. Nevertheless, here is the cross down that we pinpointed yesterday. Here is the cross down in the stochastic we were talking about. It went into the lower quintile, and there's quite a bit there on offer. So that's some feedback for yesterday. But now remember, what do we look for in the webinar? What do we look for? The methodology of the webinar, and it's not the only methodology out there, but it's the one that we use in the webinar, is that we look at which way the primary trend's going. Either it's going to be up or it's going to be down. And then what we do is we look for the corrections. So the dips in the uptrend and the rallies in the downtrend. And those are effectively the points that we try and exploit. So here and here and here and here and here. So given that, let's go back to the US dollar chart, because it looks as if there is something potentially setting up here. Okay, will it follow through as it did yesterday? That I don't know. That's why we've got to use stop losses. That's why we've got to use risk management. But if we go through to the US dollar chart again, and we'll come back to Euro US dollar. Okay, here is the dip. Here is the dip to the central pivot. Is the central pivot going to come in as support? Well, we don't want to predict that. We want to react to that. So it looks like we've got an overlap of support here. And if we get bullish crossovers in terms of the EMAs, let me just clean this up. It's looking a little messy for my liking. If we get the green exponential moving average crossing above the orange exponential moving average, and it's a two trigger system and stochastic pushing higher, those are the triggers. Does that guarantee success? No. Okay, that's why we use stop losses. That's why we use risk management. The next step in the chain would be we would need to see the momentum, and the momentum is typically represented in the upper quintile for longs and in the lower quintile for shorts. So nice move yesterday. Is there going to be follow-up today? Well, it looks like there is a potential setup here. Does it manifest? That's the challenge of the trade. Let's go through to Euro US dollar. Okay, similar. We're coming now towards a central pivot. Question is, will it be a key reaction level? We don't predict. I don't know if it's going to be a key reaction level, but if we get the EMAs to cross down over here and we get the stochastic to cross down, okay, that means that the short-term traders are lining up with the longer-term traders. That would be the triggers. And then, of course, we've got to wait to see if the momentum, behaves accordingly. If it cooperates, that's the best way to look at it. We form a view. The market's going to do what the market's going to do. Okay, we've got no control. It's really us forming a view and then seeing if the market cooperates with us, because that's the nature of the game. So potentially some resistance here, potentially a key reaction level. Remember, we're looking at the higher time frames first, and then we moving down to the lower time frame for timing purposes. Timing, exceptionally difficult to do. Some say impossible to do. That's why we're trying to line it up with the longer term trends. Another instrument I want to show you because it's on the move, gold. Let's just take a look at gold. All right, we're going to do a top-down analysis here. Now, gold has changed up considerably since we looked at it last. It's I suggested this could be a lower peak here, another lower peak in the series. And the way that we were going to measure that is with our reference candle reversal, where there's three conditions. Condition one, it's going to the reference candle has to have the highest high in at least a 3-candle cluster. Number two, the candle to the right has to take out the reference candle's low. We've got condition one, we've got condition two, but we don't have condition three. What's condition three? It has to close below the reference candle's low. But we're not done yet. We've got 1 day left of trade. So we don't really know where gold is going to end for the week. What I can tell you is it does seem to be showing a lower peak here and a lower trough here, and the RSI is below 50. It's a very shallow downtrend. It's not like it's falling as if the ground's collapsed. It's not looking like that. In fact, if we take a look at the daily chart, we haven't really slipped into zone 3, so not quite as directionally biased, say, as the euro is. Nevertheless, there is potential fundamentals at work here. Gold tends to move up to the dollar. The dollar potentially, gold has been resilient, no doubt about that. But what we want to see is, okay, is there going to be So we've had quite a volatile day with gold here. It's moved all the way to R2. I think it's worthwhile just keeping an eye on R2. I don't know if it's going to be a key reaction. What I want to do is wait for the crossover of the EMAs. I want to see the crossover of the stochastic. Now, we won't get gold moving antithesis to the dollar unless it moves into the 20 minus area. So that 20 minus area is really the indication that the momentum and the market's starting to cooperate with our thinking. All right, as I said, I've got a meeting at the top of the hour, so this is as far as I'm going to go. I just want to see if, okay, there's a few questions here. James just asking, what are the pivot settings? Okay. What influences gold, the dollar or the demand for gold? Okay. And ARM is 25% plus. You're absolutely right. So ARM listed yesterday. Very much a risk-on environment. Okay, the pivot settings. James, these are classic. I think that's what you're asking. These are classic. Okay. There's others. There's Camarilla, Woody, Fibonacci, floor. These are just classic. Okay, so I think that's what you're asking. Just let me know if I've answered your question. What influences gold? Great question. Great question. So the way that I see it, Kim, is it depends on what's driving the market at the moment. But the way that I see it is as follows. Gold's ticker is XAU USD. Okay, so the US dollar is part of it, as is gold. What is this? And what is this? Okay, so this is 1 troy ounce, and this is just USD value. Okay, this is actually an equation. Okay, it's a fraction. What you've actually got here is as follows: XAU divided by USD. So the answer to your question is, what drives gold? Well, both the numerator and the denominator is going to drive it. So the numerator is the demand, okay, for gold, and the numerator, yeah, is the demand for gold. The denominator is the dollar. So there's dual effects here. Whichever one is the stronger force at the time is going to drive. So if the dollar is moving up, it's going to put pressure on gold. But if the force of demand is stronger, then you'll ultimately get an upwards movement. It will just be sluggish. You've got two forces there. Does that answer your question? Let me know. Okay, cool. All right, guys, let's wrap up here. I want to thank you for joining me today and for the week. Have a great weekend ahead, and we shall chat come Monday morning. Thanks very much, guys.